Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is self-storage expert Tom Dunkel. Now, Tom is a chief investment officer at Belrose Storage Group, where he leads a seasoned team of real estate investment professionals who specialize in acquiring underperforming self-storage facilities in the eastern U.S. Now, with a background in corporate finance and 25 years of real estate and investment experience, Tom has taken Belrose from startup to a world-class organization. Tom has specialized in discounted asset opportunities nationwide since 2006 and is a graduate of the University of Delaware and also earned his MBA at William and Mary. And so with that, guys, I'd like to welcome Tom Dunkel to the show. How you doing, Tom?
Hey, Kevin. Thanks, buddy. It's great to be with you and the listeners today.
Excited to have you here. Excited to learn more about you and your business. And again, gave you a brief bio there, brief introduction. Maybe take a few minutes, Tom, for those that aren't familiar with you and your background, and tell us a little more about yourself, and then more specifically how you found your way into the world of self-storage.
Sure. Yeah. Thanks again, Kevin. I'm Tom Dunkel, Chief Investment Officer here at Belrose Storage Group. And as you touched on briefly in my bio there, I did actually start out in corporate America after business school. I was doing mergers and acquisitions and raising capital in the aerospace industry, which was a ton of fun. I was working with some retired Air Force colonels and fighter pilots, that were flying planes off aircraft carriers, and actually worked with some retired astronauts as well. So that was pretty fun. And fun fact, I actually had lunch with Neil Armstrong. So that was pretty cool.
That's pretty cool.
Yeah. He was on our board of directors of our company. And when the board came in for a meeting, I did a lot of support work with the CEO and the CFO. And so the CEO was like, hey, why don't you, come in, have lunch with us? I was like, sure. So that was a lot of fun. Really got just an awesome foundation there in the corporate world. Just how to run a business, how to build a business, just the fundamentals and nuts and bolts of doing deals, raising capital. I was the spreadsheet nerd, so I was building the models, doing the projections, the valuations of the companies that we were targeting for acquisition. So during that period of time, I did over $1 billion worth of deals, which sounds kind of crazy, but that those numbers in the corporate world tend to be a lot bigger. But I found that, through that grind, I was, working hard, having a ball, but I found that I was making other people a lot of money. So I progressed from there into a third-party logistics company, and ultimately into a couple of other corporations, publicly traded, and but always had my eye on doing something for myself, doing something out, entrepreneurial. And that chance came along in 2006 when I got fired from my corporate job. And now I was a vice president at a publicly traded company. So I did have a little bit of golden handcuffs there. And so on my exit, I did, get a little pile of cash to go and start my entrepreneurial venture. But of course, like I just mentioned, it was 2006. I decided I want to go into real estate. To build my, real estate fortune, right? And of course, the next few years, I just got my, butt kicked as the Great Recession came along and taught me a lot of very hard lessons. But I was determined to, stay out there on my own. So just had to, reinvent, right? When you get knocked down, you got to pick yourself back up. So around that time, 2009, 2010. I started learning about distressed mortgage notes. And I also ran into and became business partners with Joe Downs. We've been business partners now 13 years because he was in the commercial real estate industry, which got crushed. I was in residential, which got crushed. So we said, hey, let's see if we can, make a go at something new. So distressed debt was and continues to be a great business for us. But it's a very volatile business, right? So there's lots of ups and downs, and the market for distressed note pools can dry up, and then it comes back, and it's very unpredictable. So we wanted to find a way to kind of smooth out our lives, right? We have wives and kids at home, and it was like, some years we would be great, others would be very lean. And so, we wanted to kind of smooth things out. So we looked at hard money lending, we looked at residential fixing and flipping, we looked at multifamily, and around 2017, we started learning here and hearing more about self-storage. And 2018, we said, hey, this is a really solid business. Let's get more educated about it. We were talking before we hit record, or before we started the show, that I guess, Kevin, Scott Myers, who is a friend and mentor and business partner of ours as well. And so we started learning through Scott's group. In 2019, we joined his self-storage mastermind group, which is a nationwide group of self-storage professionals. And we were convinced, like, hey, there's really some good stuff here, solid asset class, consistent over a long period of time, ups, downs, everywhere in between. And it's a very fragmented market, right? So we got a lot of moms and pops out there that are not running these facilities very well, as opposed to the big guys. Everyone thinks, oh, public storage, extra space, what have you. Those big guys, they only control about 30-35% of the market. So the rest of the market is regional players and moms and pops that don't run it like a business. We said, hey, there might be something here, but we needed to round out the team, right? So through our mastermind experience, we were able to add in a lead generation guy that allows us to find off-market deals, which everyone knows those are typically the better deals, as opposed to a auction environment through a marketed deal. Mm-hmm. And then we needed, of course, once you raise the money and find the property and you buy it, well, now you got to run it, right? So we needed to find an operations person. So through our mastermind community, we were able to bring in a very experienced, nationally known operating expert named Catherine East. And so she's worked with hundreds of facilities around the country doing transitions and management consulting and auditing and all that good stuff. So we brought her on board. And so once we had that team together, we were like, okay, now we're ready to roll. So 2020, we bought our first facility, and fast forward to today, it's now early April 2023. We just closed on our 12th facility. And so we've acquired over 350,000 square feet or so of self-storage across 7 states. So we're excited about where we're at. We're excited about self-storage.
Okay. Yeah. Fantastic. I appreciate that background. And, the first question that comes to mind, or at least just as we kind of talk through the evolution of your story, you got started in real estate in 2006, entering into, the Great Recession. And now we find ourselves in maybe not a similar scenario, but again, some volatile times. The debt markets are all over the place, just a lot of uncertainty. Have you guys experienced any just slowdowns or hiccups, or have you pulled back the reins a little bit in your business given the uncertain times we find ourselves in?
Yeah, great question. Yeah, so things have certainly been a bit dynamic the last 6 months or so. I know when we closed 2 deals in the fall, and leading up to those, we had on those deals we had debt like in the 5s on those. But then we had another deal come along during that time period. We went and got additional term sheets for that new opportunity, and they started coming in at 7. And so all of a sudden, and it's not like it was a surprise. We knew it was coming. Sure. Obviously, the writing was on the wall. But that was like, okay, here it comes. Things are starting to shift. But we decided, hey, we're ready for this. We're going to persevere. We've got the team. We love our niche, so we're just going to keep moving forward. And so we're obviously going to be a lot more cautious, a lot more careful. We're going to stress test our models with not only higher interest rates on debt, but lower LTVs, higher exit cap rates. And that's all from my corporate training way back when I was doing the deals for the big private equity guys. And so we do a lot of that kind of stress testing. And if it doesn't hit like kind of a minimum threshold in kind of a rough scenario, then we'll pass on that deal. So, there's definitely a period of time there, Kevin, where we had sellers, right? They were thinking their facility was still worth what it was a couple of years ago. And so we had that bid ask spread there for a while. But what we're finding now is that is narrowing. And so our acquisition pipeline is quite active right now, quite
Okay.
active.
Yeah, no, that's what I was going to ask you. That I'm curious, because we've got a similar direct to owner off market strategy. We've been doing it for many, many years, not in the self
Mhm,
storage space, but in the mobile home park space. And it's interesting looking
mhm,
back, 7, 8 years ago, a lot of the, mobile home park owners, they, unless it was in a primary market, they probably didn't have a litany of brokers kind of chirping in their ear about, valuations. And there's always someone out there willing to pay or more than your group. That's just the case, right?
sure.
That's a
Right.
fact, right? And
Mhm. Yep.
we might not agree with what they're willing to pay. It might not work in our economic model, but like it might work for them. And
Mhm.
so, but what I had found is that a lot of the mom and pops, the fragmented nature of mobile home parks, a lot of these mom and pops over the last 3 or 4 years, not that they're much more educated per se, but just that they've got a number stuck in their mind, and most of the time it's a direct result of not just one but multiple brokers
Yeah.
over the year or two or three. Just kind of, again,
Sure.
I can get you this for your property, and just not really even understanding how they arrived at that number. But that number gets stuck in their head, and getting them to reset and reset their expectations on the valuation today has proven challenging in a lot of instances with us. And again, a lot of them don't. They know that the markets have changed as far as the debt markets, but a lot of them might not be sophisticated enough to really understand how that actually factors in to the overall value of their property. Have you found that to be difficult to re-educate sellers, or has the market already kind of done that for them in some of the assets you're working on, meaning that they've maybe received a number of other
Mhm.
offers that are substantially lower than where their number was, and now they realize that, okay, things have shifted, and maybe the offer that Tom and his team have thrown up, that's fair. It seems fair now because I've got three other offers in that same realm.
That's right. Yeah, I give my partner Joe huge credit. He's in charge of the front end. He's in charge of that acquisition funnel,
Yep.
and one of his superpowers is building that rapport with sellers. And so he might have to have kind of a tough conversation with them early on when they're stuck at their old valuation, and we really need it to be down here. But he's not. He's trying to be almost consultant for them, right? He's not really pushing one thing or the other. He's just trying to lend, hey, here's our experience. This is what we're seeing out in the world. And he has that magic to be able to just really connect with people. And so oftentimes he'll have a seller say, well, either I'm going to hold out for this value or I'm just going to keep running it. And, I'll, come back to me in a year or two.
Yeah.
And then like 3 months later, they come calling back, like, because once those wheels start turning in the seller's mind, and they, especially these moms and pops, they might be getting to a certain age, or they might be running the facility themselves, and they just have that fatigue. It's just kind of a waiting game. So a lot of times they'll come back and they'll be more realistic. And one thing we're seeing, Kevin, I don't know if you're seeing it in mobile homes, but we're seeing a lot of seller financing right now, which is great, right? Especially with the banks kind of in flux right now. So we're seeing a lot of that, which is a big win-win for sure.
Yeah, no, I think that is definitely one of the. I wouldn't say we're seeing a lot of it. It's interesting, again, just looking at comparing the mobile home park space. I would say if you asked me that same question like 6 years ago, um, it was readily available. I'd say probably half the deals we did were there was an option of owner financing.
Right.
Over the last 5 years, not so much. We just did a pretty phenomenal deal at the end of last year that's got some great seller finance terms, but
Mm-hmm.
you know that was not the norm for 5 years. Most people just wanted their cash. They wanted their cash and run. It seemed, at least that was our experience in our niche. But seller financing is a beautiful thing. Now I think one of the selling points that can be made to sellers that might have a slightly higher number. Maybe there's a middle ground that you can reach them at, that you can meet them at.
Mm-hmm.
But in order to get that middle ground, which is a higher net number for them, they've got to provide you with some, fairly attractive seller financing terms, more attractive than ultimately what you'd be able to obtain from a local bank. I found that to be the common meeting ground in the middle that has worked, at least with this last deal we just did. We got probably some of the best financing terms that we've ever received, even compared to when the rates were at their all-time lows. And so, um,
Nice.
the deal would have worked without that, but it works really
Just
well
juiced
with
it.
those. So
Love it. Love when that
Yeah.
happens.
So, your strategy, I know your portfolio is spread out amongst multiple different states. I know that you're really trying to your conversation before the call, before we start recording here, is you're really trying to hone in your efforts in the southeastern states. But I know that you've got some things scattered out amongst the northeastern states as well. I guess what is the looks like there could have been a little bit of a shotgun approach, but you're maybe trying to hone that in a little bit.
Mhm.
Where are the markets, or I guess what are the states that you guys are really interested in, really putting the emphasis in?
Sure. Yeah. We have had just some kind of bluebirds come in some different areas, but we're honed in on the Southeast for a lot of the same reasons. Other asset classes are doing well there, right? There's population growth, there's job growth. There's tons of infrastructure investments being made down there. So it's just creating a lot of demand for lots of different asset classes, multifamily, I'm sure mobile home parks as well, and of course self-storage. But I would say Georgia is a big area for us right now. Tennessee, we're looking to kind of move into that state as well. We've been in Florida for a while. We're actually looking at exiting those facilities because things are, at least for the areas where we are, we're still looking to acquire there, but at a certain point in our value add strategy, right, there's only so much we can squeeze out of each of those facilities. So when we do hit that point where we feel like we've maximized our value add strategies, we'll keep an eye out and look to sell if it's advantageous, or just sit on the cash flow if the market maybe isn't getting us the number that we're looking for. But
Yeah.
yeah, we're looking for those markets where we're seeing some positive dynamics on the demand side, but not too much activity on the supply side.
Yeah. Talk to me about the typical business plan. I know every deal is a little different than the next, but the typical value add business plan when you guys go into a facility, in the mobile home park space, we like to look at it as like low hanging fruit, medium, and then high hanging fruit. Low hanging fruit is simply that of, current rents are not at market, right? Like that's literally just a matter of sending a rent increase notice out. That's really low hanging fruit. Medium hanging fruit would be some operational inefficiencies that we can fix fairly easily. It just might take some time. And high hanging fruit for us is capital intensive, and that's maybe bringing brand new homes in, and then filling vacant lots or developing another portion of the park. Like it's capital intensive, takes a good bit more time than the other two. And so what is the the normal value add plan or strategy in these self storage facilities?
Sure. I mean, that's one of the things we love about storage is it's not rocket science, right? We're not splitting atoms. It's not terribly complicated. What happens is these moms and pops, especially after the past couple few years where COVID has really pushed up demand on storage and therefore pushed up rental rates, those folks that were asleep at the wheel all of a sudden are 20%, 30%, even 40% below market rates on their rents. So I know it's not sexy or exciting, but that's a huge low hanging fruit strategy for us, is just boiling that frog slowly. So depending on the market, we can be a little more aggressive, or maybe we need to be a little less aggressive, but we're eventually looking to push those rates up closer to market. And I mean, it's pretty simple. It's very easy, low hanging fruit. I would also put in that bucket, Kevin, tenant protection. So we can't call it tenant insurance, but it's the same concept. Tenant protection is just another little revenue stream that we can tack on there. And it might only be, maybe $5 per unit per month. But if you multiply that over hundreds of units and multiply that out over 12 months and throw a reasonable cap rate on that, we can add hundreds and hundreds of thousands of dollars of value to a facility with something that, really easily. So we like that one.
What's your net profit margin there? Obviously, you're buying that service to a third party, but what is the actual profit margin on something
We're
like that?
we're at about 50%,
Okay.
50%.
Yeah,
About
that's
half.
fantastic. Okay. How about some other ancillary income streams, or other areas where you can add additional value that might have been overlooked by,
Sure.
current mom and pop?
Well, a huge one for us is technology, right? So we really leverage technology as much as we can because that allows us to lower our personnel expense, which increases our NOI, which increases the value of the facility. So we use technology. So we we're using search engine optimization, SEO, so that when someone's on their smartphone and they say, hey, I need storage near me, we're going to pop up really high on the Google search there. And then they can click through that link and they can actually rent a unit right there from their smartphone. And then they're texted a gate code, and at their convenience, they can go over to the facility, let themselves in. We have a lock inside the storage unit, so they can direct themselves to the storage unit, roll up the door, there's their lock, empty their stuff, lock it up, and they're gone. Similarly, the number one reason someone rents from a self-storage facility is because they drove by it, right? And because we don't have boots on the ground at a facility all the time, we have a QR code on the front gate. And so the QR code allows the customer to drive by, scan the QR code, takes them to the website on their phone where they can fill out their paperwork, sign it with their finger, enter in their credit card information, which we love, right? Because then it's auto pay. Turns into a Planet Fitness kind of model where it's more of a pain for them to cancel it than it is to just continue with it. And then again, it just texts them a gate code. They can let themselves in, and etc. So that really allows us to have our managers on site very little, and we can have a manager covering 3-4 facilities at a time, which again helps us to reduce that cost and increase our NOI.
Yeah, I was going to ask about fully automating facilities, and just, I guess, let's speak to your model. Maybe one manager oversees a number of facilities. What is the response, the daily responsibility of that manager? I mean, they just kind of just the eyes and ears, making sure that nothing weird's happening, and just stop by each facility on a daily basis, or are they involved a little bit more than that?
Yeah, 100%. I mean, they are acting as a call center, right? So each one of our facilities has it's a dedicated cell phone. So that cell phone is with that manager all the time, whether they're in Tennessee or Kentucky or North Carolina. And so a lot of those customer inquiries can be handled that way. It's just the nature of our mobile and technologically advanced world these days.
Yep, got it. And how about some other ancillary incomes like U-Haul? Is that a big one? I mean, is that a profitable center, or profitable enough to deal with the headache associated with it? Because it seems like it takes up a lot of valuable potential real estate.
No, we stay away from U-Haul.
Okay, why is that? I'm curious.
So well, you just hit the nail on the head. It's more of a hassle than it is the profit. So the U-Haul puts a lot of responsibility on the manager of that facility. So unless it's like a brand new Class A facility where we're gonna have a manager there anyway, and that's not even our game. We're playing a different game. U-Haul just doesn't make sense. They're very demanding about how their trucks are handled, and you got to go. You might have to send your manager to North Carolina to drive a U-Haul truck down to Georgia, and it just doesn't make any sense. And we feel the same way about boxes and tape and foam and bubble wrap, all that stuff. We don't do any of that. It's low margin stuff that requires a lot of hand holding and that management attention that we don't see the value in doing that.
Got it. Curious to know also, just I'm hopping around here a little bit, but curious to know what the average length of tenancy is in a self-storage unit.
Sure. Yeah. So it's funny, when the customer comes in, they'll tell you that they're going to be there like 2 or 3 months, right? But the average stay is about 18 months. Yeah. And it's not unusual to have a customer who's been there for 5, 7, 10 years.
Got it. Yeah. I mean, once you put your stuff in there, it just you're like, God, I just don't want to go move again. I mean, moving is the worst, right?
That's right.
Yeah. You compared it to the Planet Fitness model. Absolutely. I love that model from a business perspective. I hate that model because I've been a member there before, and but it's easier just not to cancel it. It literally is. There was probably a number of years where I was literally going to a different gym, but it just, you had to physically, I remember they made it so incredibly difficult. You had to physically go and cancel it. Maybe they've changed it now. Like, you could not go on the app, you could not go online and do it. You had to either call somebody, or back then I believe it was physically go in and actually cancel it, which was bullshit.
And not only go in, but you have to go. This is, I don't know, I might be wrong, but I think you had to go into the Planet Fitness where you signed up.
Oh boy. Yeah. Talk about hurdles.
Right.
Yeah. Good deal. So just, just talking about the long-term viability of this asset class, but more specific
Mhm.
to like your business model. Just yeah, everyone's got a little bit of different approach of of whether they're in the same asset class. They might run it differently. They might have a different long-term vision. So, talk to me about Belrose. Like, what is the long-term business vision? Is it to buy and hold as many facilities as possible? Is it to buy, you know, increase the value by executing on your value add business plan and exiting out and then rinse and repeat that process over and over again? Or is it a hybrid of the two?
Sure, yeah, that's a great question. The answer is a hybrid. So we look at the value add, like the short-term hits, like we're about to close on a deal this week where we're selling a facility that we bought 14 months ago because we squeezed all the value out of it. We increased the value substantially. Our investors are going to do great. But there's just nothing more we could do with that facility other than just, coupon clip. And that's just not our business model. We want to compound those returns, right? So we want to sell out of this one, get into the next one, and so on and so on and so on. Now that's our business model for Belrose to generate some of that velocity, right? Because what that does, frankly, is it helps us keep the lights on here, right? So we have a team we have to pay for, we have overhead, we've got rent, payroll, etc. So we do earn acquisition fees and we earn profit splits when we do a good job and we make money for our investors. So those dollars help us, just keep the team going, make sure we're finding great deals for our investors and handing them over on a silver platter. On the other hand, we are starting to look at development deals, and those are going to be minimum 5, maybe 7, maybe 10-year deals, and those are going to be a little slower evolving, right? Because when you build a new facility, it's great, it's beautiful, but all the units are empty. So now you have to go through the lease up process and then probably refinance and then et cetera, hold that down the road. And that's where we see, if you will, we have our value add strategy, which is kind of our checking account, right? And we have our development strategy, which is more of our long-term wealth building, because we invest in all of our deals ourselves. So we're bringing investor partners along with us to build wealth as well. And that wealth building channel is also where we're looking at not only developing traditional self-storage, but we're also looking at boat and RV storage. And there's another asset class within storage starting to emerge. They're called contractor yards, so contractor storage. And that's a big one as well. So that's more of our long-term vision, is that more the development and building and leveraging into those new asset classes within the storage world.
Got it. And the last question here, just want to be respectful of our time here. Last question, and we'll wrap it up. Is, I always like to, we talked about a lot of the good, but we didn't talk about any of the bad per se, and not necessarily speaking to like a deal that went sideways, what have you, but there's always, every time we go into a new deal, every time we, underwrite something, put under, go through the, negotiations, put under contract, our intent's to always close on it. But, sometimes there's more skeletons found than what's anticipated. Maybe the seller's financials were cooked, they cooked their books, what have you. Just, there's something changed and pretty significantly that ultimately made us walk away from a deal. Are there any deals that come to mind that you got into it, you got pretty far along and decided just to pass on it? And if so, why?
Sure. I mean, yeah, Kevin, we're very disciplined. I think that's something that I brought to Belrose just from my past experience in corporate world. But we were looking at the stats recently. I think we're looking at 40 or 50 facilities for every one that we buy. So yeah, when we get into it and the numbers don't make sense, like you said, a lot of these moms and pops, that maybe they're not doing it intentionally, but their numbers just don't make sense. Maybe they're running things through the business that they shouldn't be, or conversely, maybe they're not running all the expenses through. Maybe they have another business next door and they're, kind of playing games back and forth. So we do a lot of due diligence on the facility itself. Not only the financial due diligence, but legal, the zoning and the operations. We look at the physical plant, right? We're getting inspections, we're doing environmental tests. And so any of those things that can go wrong, it'll give us pause And if we can't get a reasonable answer or find a workaround, then yeah, we're going to walk. No questions asked. Because again, we're putting up our own capital alongside our investors. So we don't want to lose money either. So
Yeah, no, fantastic. I appreciate you sharing that.
Mhm.
You know, for those that want to learn more about you, your company, and what you have going on in town, where's the best place to find you?
Sure. Thanks, Kevin. This has been great. Again, I'm Tom Dunkel. I'm Chief Investment Officer at Belrose Storage Group. You can find us at belrosestorategroup.com. We also have a Belrose Storage Group Facebook page, which is where you'll see some of my podcast interviews and other ads or other articles that we post there, value add kinds of things about, should you invest in a development deal or an existing deal, and just things like that. We try to add value to our investor group out there. But on our website, belrosestorategroup.com, you can register in our investor portal if you're interested in investing alongside with me and my partners. That's where we post our opportunities that are coming up, and that's where the pitch deck is and the offering documents and all that good stuff. So I would invite folks to come find us there.
All righty, fantastic. Well, Tom, it's been a lot of fun having you. I appreciate you coming on and sharing all your valuable insights with the listeners.
Thanks, Kevin. It's been great. Thank you.
All righty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.